Welcome back to Real Estate Mindset. Happy Wednesday morning, you guys. This is our Wednesday live. I'm starting a little bit early because Jerome Powell is about to speak. So I figured we'll cover Jerome Powell's speech here in a second. He's running a little bit late. But while we're waiting for him to get on, you guys, and we listen to what he has to say next, I just wanted to give a special shout out and, congratulations to Jeff M. Some of you guys that have been following my channel know that Jeff M has been extremely frustrated. He's in a housing market where it's been like pretty much no inventory, massive bidding wars. But one thing I just wanted to let you guys know that Jeff, basically, you guys, here's the thing. He did research. Okay, that's my point. He did research, and even though he was frustrated because you guys probably saw the comments, Jeff was always like, bidding wars, it's never going to correct, it's never going to go down. But the one thing that he didn't lose was hope and encouragement. And when we lose hope, you guys, and when we lose encouragement, things get a lot harder. But Jeff remained encouraged, even though he was frustrated. I used to always talk to him. He used to vent on me, but he remained hopeful, and he never bought into the fear of missing out. The home that he just put an offer in, guys, he was able to secure for $30,000 under what the highest bid was. One of the ways he was able to do that is he wrote a 3-page heartfelt letter to the seller, and the seller chose his deal over the deal that's $30,000 higher. Now, I don't know if I would do that myself because $30,000 is a lot of money, but they certainly did do that and they accepted it. So if you guys see Jeff, there's Jeff right there. What's up, Jeff? I'm sorry, Jeff. I'm always telling you guys Jeff's business. He's right there. But Jeff, big congratulations to you, man. I just wanted to tell the viewers that you didn't just stumble upon that deal. That's the point I'm trying to make, Jeff, that it's not just a fear of missing out thing, that you were researching. You did, ample research. You didn't bid over. You weren't in bidding wars. You used the letter and you stayed firm on your price. And that, my friend, in my opinion, and that makes you a winner. All right. Now, I also want to say this, you guys, 2 other things. It's his primary residence. Okay. And he has an expectation where the home value can possibly drop another 10 to 15%. So Jeff has proper expectations. What I'm seeing behind the scenes, you guys, is these buyers right now are maxing out the pre-qualification. These buyers are not as strong as they think that they are. So Jeff, you did it right, man. He understands that values can continue to go down. He's willing to do that because it's his dream home, y'all. And he's not really, as far as the monthly payment, he's not overextending. He has money left over, things of that nature. So Jeff, brother, I love you, man. When I first heard that you bought, I was like, no, we're losing a soldier on the front line. We're losing a soldier. But the reality is Jeff just reached the finish line sooner than we did. That's all it is, man. So Jeff, I love you, man. You better not disappear on us. You better keep us up to date. And then let me know, Jeff, did you do your, how'd the inspections go? So the inspections were done. But anyways, guys, we're going to do a quick market update. And I can see here that Jerome is now speaking. So let's do this instead. I'm going to do a quick market update. She's just talking right now, but I just wanted to show you guys where we're at. Here's the 10-year Treasury. 10-year Treasury actually ended up about 4 basis points higher yesterday. It's starting the morning out about down 2 basis points. It's pretty much been sideways for the last week, I would say. Now take a look at this. Here's the mortgage. And look, did you guys see what I'm saying? Every time I do a live, look at, again, it's at 6.92. Can y'all explain that to me? How every time I'm doing these lives, it's 6.9 something. I'm thinking this is going to go up when it updates today. I don't know that for sure, but I would anticipate it's going to go up because we ended yesterday with the 10-year in the positive. Okay. So I also wanted to go over a couple of videos that are really crazy, like this one right here. This is a very interesting video, you guys. This guy is basically saying as soon as rates hit 5%, we're going to have an inventory dump. So he's a little bit bullish, obviously, but let's go back to Jerome. Let me see here. Let me know if you guys can hear the audio, okay? Let's listen to what he has to say. And what I'm going to do actually is, I know what I'm going to do. I'm going to do it like this. Okay? Let's listen to what we have to say. Let me know, you guys, that the audio is okay, all right?
But what goes with that resilience is
oh my gosh.
very tight labor market.
Y'all hear the echo?
Which is shown through in pay awards. But also showing through, we've got an unemployment rate of 3.8%, which is historically right.
Can y'all hear that echo? I can't even listen to
that resilience is coming through that way. But when we looked at the
this is Powell talking.
driven by evidence.
Right here, Kim.
The cumulative data, both particularly on the labour market and on the inflation release we had.
All right, I'm going to mute my mic, guys. Let me know if that echo's still here.
Caused us to conclude that we had to make really quite a strong move at that point. It was justified. My own view on that was, if we were really of the view that we were going to do 25 and then we were really sort of baked in for another 25.
I think there's still an echo when I mute, right, guys? So when I mute, I'm going to mute my mic now. Let me know if there's still an echo.
As Christine said, we will be evidence-driven, so we will wait for the next set of evidence for our next meeting.
So there's something wrong with the audio on their end, y'all.
Well, we'll have a full forecast.
I'm not.
Have you received a lot of flack for the move?
Well, I think at the moment,
Yeah, I'm muting my mic and it's still echoing. I think it's.
Central banks. We have a job to do. I'm very clear that our job, almost as clear, our job is to return inflation target.
Yeah, you guys. So it's not. Let me mute this again. There's something on their end as far as the echo. I don't know why it's echoing, guys. It's not on my end. I muted my mic. So that's unfortunate. But anyways, the central bank governors are speaking with the ESCB forum. And you guys, it's like, I'm hearing it. It's just the echo is it's just too much. The echo is too much. So let's go into this video right.
Christine, thanks for.
Jerome's talking too. So let's listen to Jerome talk real quick.
Maintaining the level of federal funds rate at its current level for this meeting. Thank you. And we did that. If you think about it, we've raised the federal funds rate by 500 basis points since a little more than a year ago. And we think, so we've come a long way. We also think that there's more tightening power coming through. Really, policy hasn't been restricted for very long. We started at negative real interest rates. We've now moved up to where we actually are in restricted territory. But we haven't been there very long. So we believe there's more restriction coming. And what's really driving it,
isn't it crazy that they can't even get their audio right?
Is very strong labor market. We've got a labor market that where jobs are being created, there's strong wage gains, and that's driving spending, driving real incomes, driving spending, which is driving more demand and continuing to drive labor market. So the labor market is really pulling the economy. And my colleagues and I, as you will know, wrote down at RCP 2 more additional rate hikes. The median was quite a strong majority, actually wanted 2 or more rate hikes. And the reason for that was, if you look at the data over the last quarter, what you see is stronger than expected growth, tighter than expected labor market, and higher than expected.
How about that, guys? Can you still hear it? Can you still hear this? Let me know if you can still hear him, because if so, we're probably good.
So I don't get why you didn't raise rates at the last meeting.
You guys hear that? Please let me know if you guys can still hear it. Can you hear the channel? Can you hear them talk though? Okay, cool. So
what we're aiming for is a stance of policy that's sufficiently restrictive to bring inflation down to 2%.
This is okay. Let's go to CNBC. So what I'm gonna do, guys, is I'm actually just gonna go to CNBC. I'm really sorry about that.
We did 4.75.
Pretty sure it's not on my end, but it may. I'm gonna
in December we moved down.
exit out of this. We're just gonna go to CNBC because they're covering it. CNBC, real quick. I apologize, guys. Just bear with me here. No echo on their channel, just mine. I don't know what's up with my echo. I'm going to remove the share screen. I'm going to stop it. I'm going to represent share screen. Go entire screen, share system audio right here. Okay. All right, here we go right here. Let's see if this is better, guys.
So maybe in every other meeting hike.
We've not decided that. So the only thing we decided was not to raise
Okay.
rates at the
We're good.
June meeting. We have not made a decision to go to that. It may work out that way. It may not work that way. But I wouldn't take moving consecutive meetings off the table at all.
I'm trying. Governor Maida.
I still hear the echo.
First of all, it's great to talk to you. We haven't heard much from you outside of your policy meetings.
Jeez, guys.
I think the world
All right, well,
wants to know why you're the global outlier here. You have decided to maintain your easier monetary policy in the face of rising inflation.
I don't get it.
So, a simple answer would be.
All right, guys. I'm not.
headlining
One thing that drives me crazy, y'all, is the audio. we're gonna move on to a different video. Hopefully that will get better. I want you guys to listen to this next video. This one's crazy. I'm really sorry, you guys. It's on their end. I tried to reshare screen. I tried to reset my audio, but it's just not working. So let's move on to this video. If I may, I think you guys are gonna love this video. This is
Summer in San Antonio.
Let me have the ads play real quick. This is the video where basically this expert is saying that when rates hit 5%, expect a flood of housing inventory. Okay, and that's the Compass CEO. So the Compass CEO is saying, please take rates to 5% so we can have inventory. That kind of seems backwards, but take a listen, you guys. Here he is right here.
With us.
Glad to be here.
You know, this just brings me right back to the beginning of the year, talking with you, and you said, you know what, the bottom's in for housing. I'm going to call it right now. And so far, it does look like the data is moving in your favor. Bottom or not, it does seem to be stabilizing. We do seem to be seeing some green shoots. What are you seeing on the ground across the U.S. in your different markets?
So across the board, there are more buyers than sellers. Buyers have accepted 6-7% mortgage rates as a new normal. We're seeing prices increase every month this year versus the prior month. And now it's just 3% lower than it was at the peak last year. The issue that we have is there's just not enough inventory. And that's because 30% of homeowners are locked into mortgage rates at 3% or below, and 70% of homeowners are locked in at 4% or below. Great time to be a home builder because they're benefiting from the price increases that are a result of low inventory.
Yeah, I spoke to Cheryl Palmer from Taylor Morrison this morning, and certainly the home builders do seem to be moving to fill in that void to the best of their ability. Are you seeing that in terms of where you're generating sales, your agents are generating sales as well? And if so, how much are things like incentives playing a role in that?
So there are definitely incentives and buy downs bringing mortgage rates down by 2 points in a number of our markets. But there was already a trend of not enough inventory and a second trend of people want things that are move-in ready. They want homes that are prepared. There's a product at Compass called Compass Concierge. We prepare homes, make them staged, painting, deep cleaning, and just make them move-in ready. It's one of our best products. But now there's just not enough inventory of existing homes because people are locked into low rates that home builders are meeting. They're meeting that demand. We actually saw last month the largest amount of housing starts since 2016. And that's because home builders, their sentiment index improved for the first time in over a year.
Tell us about two things, two A's, ARMs and Airbnb. So adjustable rate mortgages, are you seeing people pick those more now that a lot of people think we're near the top as far as where rates are going to go? And then the last time rates were this high, it was a lot harder to sort of monetize a property that you owned if you weren't going to live there anymore. So has that affected the inventory issue in a way that you can really see?
Yeah, so we're seeing people that are buying because they
send me the link.
They just got married, another life event or a new job that have to buy. Instead of selling their pre-existing home, they're just renting it out and taking the financial arbitrage of high rents and low mortgage rates. So we're definitely seeing that, whether it's an Airbnb or not. But the issue that we are seeing is we need to have an unlock of inventory. It's probably going to happen when mortgage rates get to 5.5% in a sustainable level. At that point, I would expect there to be a flood of inventory hitting the market, and it'll feel like the pandemic craze all over again.
And what are you seeing on adjustable rates?
So on adjustable rates, we are seeing an increase in adjustable rates. But the topic around adjustable rates, which I think people don't fully appreciate, is that around 30% of the people that are locked in at 3 or 4% mortgage rates had adjustable rate mortgages that are 5 years, 7 years, or 10 years. So the value of a 5% ARM they got in 2022, in 6 months, it's not that valuable anymore. You only have another year, year and a half. And so I think there's going to be some new inventory entering the market, even if rates don't come down because of those ARMs they're getting less value over time.
Dynamics around agent growth and retention, something we've talked about in the past.
Yeah, so we're happy to say, and we shared in our first quarter, that every month in the quarter we hired more agents than the month before. Every month in the quarter we lost less agents than the month before. And so it's a good time for Compass. It's still a competitive environment. There's 1.5 million agents in the country. 5% of them left the business in the last 5 months, and so we're seeing agents leave the business. That said, Compass agents are outperforming.
Stock's trading at about just under $3.50 a share. You went public at $18 a share. investors missing something here? Like, how do you react to the fact that we have seen the stock? I realize it's rallied since the start of the year, but it's sold off dramatically since it went public.
Yeah, look, we IPO'd in the hottest real estate market maybe in history. The environment that we exist in right now is one where the backdrop is mortgage rates went from an all-time low to a 20-year high in less than 9 months, creating the sharpest decline in real estate transactions in the history of the country. There are many brokerages that aren't surviving. I'm really pleased to say that I shared in the last quarter our commitment to being free cash flow positive for the second quarter, the third quarter, the fourth quarter, and the full year.
Okay.
My first one
real
latched
quick,
immediately.
guys.
So of course I thought that
Johnny just sent me the link, so I'll try that here in a minute. But I wanted to point out that this, like a lot of people, he got a lot of his information wrong, and I just wanted to show you guys that because, obviously we got to be careful who we listen to. Obviously there's a financial bias, so he has to say certain things, you guys. It's just the reality of the situation. But he basically said we haven't had starts, right? He just said it. We haven't had starts this high since 2016. So let's see if that's true. I want to just show you guys. It's not true. I already know, to be honest with you. But this is what I'm saying the problem is. He's just said we haven't had starts this high since 2016. The thing is 2016 is way down here. What's this guy talking about? And not only that, we've had this level of construction starts since about 2021. You guys can see that right here. So again, and you can see down here, 2021. So this is where we're at right now, but it did skyrocket up. So I'm not saying it didn't skyrocket up, but what I'm saying is like the guy is not being, well, his information's crossed. And I understand it's easy to do that. There's a ton of information, you guys. But what I'm going to do now is let me play one more video. And then by that time, I should have the Jerome Powell speech fixed now. Now, this email is basically, they're going to talk about home price appreciation and then basically the strength of home builders right now. Now, this evening's video, you guys, is going to be on home builders because the last two Fed economic data charts updated yesterday, which was supply and price. So I have all of that data now. I'm going to have that released for you guys this evening. We're going to look at all of the new home builders and what's going on. But take a listen to this video real quick, guys. And then I'm going to go try to set up that Jerome speech.
With Dexcom G7, you can achieve diabetes results without finger sticks.
Just kidding. Let's let the ad play, and then we're going to set up the Jerome Powell. But Jeff, I see you in there, Jeff. How you feeling, man? You nervous, Jeff? And then when you get the inspections back, man, Jeff Scott is in the inspection stage of purchasing. All right, here we go. We're good to go.
Picks include DR Horton and Pulte Group. Thank you so much, Joe. So I just wanted to first get your take on the new numbers out this morning with new home sales, much, much better than expected.
Absolutely. And I'll even go so far as to say I was more excited to see the home price data. I think the new home sales data was predictably strong given what we heard from the builders over the last several weeks. And there's also other measures of new home sales that came out last week, including the Zonda index, which actually gets a bottom-up look at some of the communities in the country, about 60% of the communities. So this number was actually not that surprising. We think that the home price appreciation that we saw in the Case-Shiller CoreLogic index, as well as the FHFA index, tells us a lot more about the strength that we could see in margins coming from the builders over the next several quarters.
How much of these gains do you really attribute to the housing supply shortage? And how long do you see that lasting? And I'm asking you this in the context of your belief that home builder stocks will go higher from here.
Certainly, and a big part of our belief that the builders go higher from here is on valuation. So on price to book valuation, which is traditionally what a lot of investors use, because the value of the balance sheet is actually very correlated to the value of the inventory that these home builders are building homes on. Those valuations are not at all-time highs. In fact, they were much higher in late 2020 and then all throughout 2021. And really, that's what keeps us bullish on where they can go from here, because in reality, the book valuations are tied to the returns, they're tied to the earnings. And so right now you see very high returns on inventory from the builders. Those are going to need to come down as you see home prices stabilize. But we still think that those returns on inventory will be higher than pre-pandemic for many of these builders, and that their price to book values will rise as a result.
Where do you think the Fed funds rate needs to be to see this supply normalize? You have this trend, obviously, of people who got mortgage rates so low. They're not going to go anywhere anytime soon, and that has restricted supply. Where do you think Fed funds needs to go from here for that dynamic to shift?
It's a great question, and I think the answer is slightly different than the question. I think it's not necessarily a destination rate. It's not an absolute level. It's stability in the rate. I heard Bob Pisani talk about stability in rates. I think that's what's really important here for home builders. You see it in the demand that's coming through the sales centers for them. It's really about last year, home buyers came into the market with a certain budget in mind that incorporated a 2.5%, 3% mortgage rate. And by the late spring, they were looking at payments that were significantly higher because of the rise in interest rates. You're not seeing that this year. People that came into the market are seeing much the same interest rate that they saw at the beginning of the year. And builders are also working with buyers, even if it's still only on a selective basis now, to buy down rates, make sure they can get into the payment. And so that's what is really more important, is the stability in the rates, not so much the absolute level. And that's why you're seeing really strong data here at 7% mortgage rates, nearly 7% mortgage rates.
Okay.
With Dexcom
So there was
G7,
that
you
one.
can
Now I
achieve
have Jerome,
diabetes
you guys.
results
I have
without.
Jerome. Let me set up Jerome right now. A lot of cheerleading, obviously, right there in that last video. I get it. But we're listening to all perspective. Let me know that the audio is good, okay, guys? This is Jerome. I paused it, so we're a little bit behind, but he was speaking. So let me turn this up. Let me know that the audio is good, okay?
Yes, well, I think widely it's been surprising that inflation has been this persistent, but I think the bottom line is that policy hasn't been restrictive enough for long enough to start to see those effects. And you know, the service sector is not especially interest rate sensitive, by the way, as opposed to, for example, the goods sector. So we wouldn't expect it to be the first to be affected, but we would ultimately expect, as demand softens and as the labor market conditions go more into balance between supply and demand, we would expect to see inflationary pressures subside in that sector as well.
Do you guys coordinate? Do you talk amongst yourselves?
Yeah, of course we do.
I mean, do you call before policy meetings?
Can I
Yeah,
just, I just want to follow up on what Jay said, because I think he's completely right. And I think that this is what I call the catch-22 issue, where we have an expected catch down where manufacturing eventually will align, or services will align on manufacturing. And that would be the logical consequence of the lag time that it takes for services to align with manufacturing and to, you know, see prices go down in that sector. The catch up is that of labor, because it is, as Jay said, labor intensive. It's generally relatively low productivity and low skilled jobs in those sectors. And also those jobs that are going to seek the catching up with pre-COVID times. And how that catch down, catch up will be resolved is going to be critically important for where inflation is heading. Because if we see inflation going down in that service sector and movement of wages while increasing at a moderate pace, then we would be in a relatively good place. But that is totally question mark for the moment.
Yeah, it sort of raises the question, Chair Powell, about whether we need to see a much higher unemployment rate in the US, and you're all dealing with a tight labor market, to finally really break inflation.
So, you know, that the way we think about that is that there seems to be a path still for labor market conditions to soften and for demand and supply to get back into balance without the kind of large job losses that have happened in many prior cycles. And the reason for that is the level of job openings that still exist in the labor market. So it's still set 1.7 job openings for every person who counts as unemployed. That has been coming down. It's come, actually, the number of job openings has come down now by almost 2 million. And what you're seeing is wage pressures. They're still high, but they're definitely coming down. You're seeing surveys of workers and businesses suggest that the labor market is not as tight as it was a year or two ago. So you're seeing a job creation is beginning to come down. There are a number of indicia that would suggest that we're getting the softening that we need. We're getting it slower than we'd expected, but nonetheless, it's happening. So it's still a possibility there. But you know, it's so uncertain right now that in my view, the least unlikely case is that we do find our way to better balance without a really severe downturn. I think there's a significant probability that there will be a downturn as well, though, but it's not to me the most likely case.
Significant probability.
That's the hard landing scenario.
or just this, I wasn't even thinking of hard landing. I was thinking of even a recession.
See, he said it.
It's not the most likely case,
right there.
but it's certainly possible. And of course, many forecasters.
High probability of recession.
Is Europe in recession, President Lagarde? I mean, we've seen 2 negative quarters of GDP. I don't know how you define it. But
I think the first quarter of 23 was actually completely flat, wasn't negative. So technically, I think you could argue that we did not see a recession, but it's stagnant, to say the least. And the expectations for Q2, particularly in the industrial sector, if I look at PMI numbers, are not particularly are not giving us great hope that there will be a strong recovery. We see a second half of 23 up from the first half, certainly, but moderate. We have a 0.9 forecast for the whole year.
Do you agree with Chair Powell? Do you think you can get away with this tightening cycle without dragging Europe into recession?
Our baseline does not include a recession, but it's part of the risk out there.
Are you willing to tolerate a recession?
Well, the interesting thing for us is that if you go back to last November, when we did a forecast, we were predicting quite a long but quite shallow recession. And the economy, as I said earlier, has turned out to be much more resilient so far. Now, I think you can sort of point to a number of things that underlie that. One of the things I would point to is the fact that we've had a very sharp fall in energy prices in Europe. And that obviously has helped with the whole question of the terms of trade shock that we've been having. It's done quite a bit to reverse that terms of trade shock, and that feeds through into national income. So I'm not surprised that we've had this reversal in one sense. What was surprising, but actually very helpful, was that, of course, we did have this big fall in energy prices and a much better winter, frankly, than we thought we would have. So, we're going through this year now in a more resilient position than I expected. So we're not currently forecasting it, but obviously we have to watch it very carefully.
How's the Japanese economy faring? I mean, it's very exciting if you look at the Japanese stock market at a 30-decade high. What's happening fundamentally?
It's doing fairly well. I mean, apart from the contribution from some inventory investment, domestic economy is expanding at a pace slightly above potential, I think, driven by pent-up demand. We relaxed pandemic-related restrictions in May, and this is stimulating consumption and investment. There's also green GX, DX-related business fixed investment taking place. So investment is fairly strong at the moment. We think the economy is going to expand at slightly above potential for some time. But there's, of course, a lot of uncertainties going forward, including what may happen in Europe and the United States.
I asked if you guys coordinated or talked about monetary policy before. I mean, does that happen? Should it be more coordinated? Because you're all doing different things right now.
Well, I mean, if I start, I mean, obviously what we don't do is say, what should we do? What should you do? Because we're all setting the monetary policy for our areas, and that's the law in all of our areas actually. So we don't do that, but we do talk a lot, and I think it's important. I mean, it's important at all times, but it's particularly important in recent times at the moment because we're facing such big global shocks. We've got common shocks. They differ a little bit in terms of their impact and their effect, but there's some huge global events going on that are affecting all of us. So, I think we do talk quite a lot and we see each other quite a bit because it's important we do that. And, we share wisdom on how we're sort of interpreting the things that are going on around us.
Yeah. I guess we are in a flexible exchange rate world, so we do policies independently. But of course, we exchange information, which is very, very valuable.
Do you think that, Governor Ueda, do you think that they are over-tightening?
No.
No, you don't. You approve of the policy. You've had a very tight labor market for a long time in Japan, even before COVID.
Yes.
Demographics.
It's working in a way to tighten the labor market for quite a long while. And it's going to continue this way for a while.
I mean, the economic conversation, it gets into an interesting question, Chair Powell, where now we're wondering, easier to fight inflation last year when the economy was doing better. But now that we're seeing signs of softness and weakness in manufacturing, and you mentioned the labor market starting to cool off, about overdoing it and the risk of overdoing it. Do you wonder about that, or you're still just focused on inflation?
Let me say the U.S. economy has actually been quite resilient, and the data that we're still seeing, including since the last meeting, still is consistent with with an economy that's resilient and growing albeit at a modest pace. As I mentioned earlier, though, yes, there was no question. The first question was how fast should we go, and we went pretty fast, and we got to a level that we believe is restrictive. We're in restrictive territory. If you take the federal funds rate and you subtract, some forward-looking measure of expected inflation, you'll get a significantly positive real rate, meaning we're probably in restrictive territory. So, and I think we have steadily slowed the pace of our moves, and it's appropriate to do so for one reason, because the more information we get, the better decisions we'll make. The risks of doing too much versus doing too little become more in balance. I wouldn't say they're in balance yet, but they're becoming closer to balance. I still believe and the committee clearly believes that there's more work to do, that there are more rate hikes that are likely to be appropriate, though.
So you think the risk is still of doing too little and not getting control of inflation?
Yes, and of course
But inflation expectations are, I don't have to tell you, very well anchored.
No, but the thing with the risks is that there may be social costs associated with restoring price stability. The social costs of failing to restore price stability will be higher in almost all likely cases. We've seen what that looks like, and it's just something that we have to do. It's the one of the principal things that society counts on us to accomplish, and I think we all feel committed to accomplishing it. It is of course a good thing that inflation expectations have remained anchored all this time, but our understanding of inflation expectations is not a precise one, and the longer inflation remains high, the more risk there is that inflation will become entrenched in the economy. So we have to, the passage of time is not our friend here.
What about a higher inflation target? I know none of you want to talk about that, but on Wall Street, there's this idea that a lot of things are changing in our economy structurally. The onshoring of supply chains and chip plants and all of that is going to be expensive and could permanently create higher inflation rates. Couldn't it, President Lagarde?
Well, at this point in time, and given the fight that we lead against inflation, the yardsticks that there is, the strategy that we've agreed, the expectations that we have, and the inflation targeting as it has been set, there is no way that any of us, I think, would consider changing the gatepost halfway or more than halfway through that journey. I think it's wonderful to have a forum like Sintra, which brings together academics and other than policymakers to actually consider those ideas and to explore them and to weigh the cost and benefit and all the rest of it. But at this point in time, I think we have to be as persistent as inflation is persistent, and we have to be resolute and decided and determined in reaching the target that we have set, and not debate the target as we are running that race.
But it does raise the question, Governor Bailey, about how far inflation will come down to.
It does, but let me reinforce what Christine said. What is the inflation target? It is the definition and practice of price stability. In our legislation, it is what price stability is taken to be. That is the 2% target. And I don't think anything has changed in terms of what we mean by price stability. And I think that's a very important point to start with. It's the anchor that we have to always maintain. Now, in terms of bringing it down, yes, I mean, we're facing, have faced and are facing the biggest challenge for a very long time. But we have to meet that challenge. I don't think it is the right thing to do to say, well, this is all a bit difficult, let's change the target. I really don't think that is the right thing to do. I think that would be a very bad thing to do. And I think, although I very much agree, as Christine was saying, that there are things we understand about inflation expectations and things we don't understand about inflation expectations. I think taking risks of that nature with inflation expectations, but also fundamentally changing what we mean by price stability when there's no good reason to do that, I think would just be the wrong thing.
How do you read, Governor Ueda, the inflation expectations? Because they've crept up in Japan as well.
Yes, we've been for a long time trapped in a zero inflation expectations equilibrium. So we've been trying very hard to move this to a 2% inflation, 2% expectations equilibrium. To do so, we had to de-anchor expectations from zero, raise inflation expectations, and in the future, we'll have to re-anchor them at 2%. This is a formidable task, and now we are seeing signs that inflation expectations are rising. But as I said, not to the extent that we are fully in the 2% inflation expectations equilibrium.
It also raises the question, you mentioned the labor market and some of the post-COVID changes about just how COVID has distorted the data and has made travel, for instance, so strong for so long. And I wonder, Chair Powell, how you look at the COVID impact on the economy and how it's changed the way you make forecasts and you think about what's happening right now.
Well, I think there are changes, and we don't know how persistent they will be. Certainly work from home, and you can see the effect on commercial real estate, particularly office real estate and the surrounding retail that it's suffering in many major cities. We don't know how long that will last. It feels like some part of that will be persistent and will last. You mentioned the data as well. We've I guess response rates to a lot of the data that we collect and the other organizations collective, the response rates have gone down, and you're seeing a lot of volatility in some of these data series, more so, I would say, more so than we've seen historically. So the data are even a little bit foggier than they usually are. But we'll be, in terms of what the effects of COVID, it's going to have long-term effects on the economy. There may be loss of productivity. There's certainly been, for a generation of kids, some loss of education and training. I think it's hard to say how persistent all this will be.
What is your level of concern of commercial real estate, since you mentioned it in the U.S.?
It's something that we, of course, are watching carefully. The way it lays out is the large banks don't have large concentrations of commercial real estate. So that's a good place to start. A surprisingly large part of exposure to commercial real estate is in the banks that are under 100 billion. But there, the worry is more banks that have a high concentration, and they're relatively few. So it's something that we're carefully monitoring. Bank supervision has a playbook for this. So supervisors are talking to banks about their concentration of real estate and what can they do and how do they manage themselves out of this. It's something that we're well aware of. It's not a surprise, and we're focusing on it.
Is it one of the reasons you were cautious in the last meeting?
Commercial real estate? I wouldn't say so. No, I just, generally speaking, it was at the last meeting, it was about, what's in the pipeline, how far we've come, what's in the pipeline. I will also say that, though, that the bank stress that part of the decision, in my thinking anyway, was the bank stress that we experienced earlier this year. There's a fair amount of research showing that when something like that happens, bank credit availability and credit can move down a little bit with a bit of a lag. So we're watching carefully to see whether that does appear. Of course, tightening in financial conditions is what we're doing intentionally. So we have seen bank credit conditions tighten. The question is, and that's what we're trying to achieve. The question is there another channel of that or a greater amount of that coming from what happened in March? We don't really see any evidence of that, but I think that's certainly in the back of my mind to see whether we do see that.
Yeah, it gets into the question about lags. How long are lags, Governor Bailey? And do you expect to see more?
It's a very interesting question in terms of the transmission of our monetary policy decisions. So if I can just illustrate it with the UK case, and obviously it's not the only part of the transmission mechanism, let me be clear, but it's an important part, and illustrate it with the UK mortgage market. So we've seen a big structural change in the UK mortgage market since the last tightening cycle of monetary policy, which of course, accepting passage of time, was about 20 years ago, actually. And that change has been a change from a variable rate mortgage market to a fixed rate mortgage market. Now, I must say, obviously with Jay here, it's not a US style fixed rate mortgage market. It's a much shorter term. So the average term is often around 5 years. But we know, and we think around about 85% of the stock of UK mortgages are now sort of in that part of the market. So we know that the transmission of monetary policy is going to be slower as a result, because obviously it depends upon the sort of the timing and the sequence of those fixed terms coming to an end often. So we have to judge that. I mean, it's another factor and another sort of element of uncertainty that we have to judge when we're taking our decisions, which is how much of the tightening that we've already done has come through and how much is yet to come through. And we know that referring back along quite a way into the past isn't going to help us in that respect. So we have to sort of formulate those views afresh. And so it is part of our decision-making calculus is how much more has to come through, when will it come through, and also how powerfully will it come through. And all those things are things we have to take into consideration. And as I said, history isn't going to be a great guide for that, given the change in the market.
So a year? What's a lag?
Well, what you see, and of course you can compute, is the sort of the profile of mortgages coming up for renewal. Yeah. Renewed terms, and we can see that over the next year or so, there's quite a lot of fixed rate mortgages are coming up for renewal. So yeah, we can factor that in. There is another element, I say, of uncertainty as to just how that will work its way through.
President Lagarde, how do you think about the lags?
I think of the lag in 3 steps, if you will. The first one is transmission in terms of tightening of the financing terms that are made available and how markets absorb the decisions that we make. And on that front, we have a good and reasonably rapid transmission. We see it in rates, we see it in volume of loans, and on both accounts, there is a good absorption and a rapid transmission of our monetary policy decision. But that's only step 1. What we need to see is step 2 and how it materializes on investment by corporate, and for households, it's predominantly mortgages. And for the euro area, there is a lot of heterogeneity, because you have markets where mortgages are at fixed rate, markets where mortgages are at floating rates, some that are readjusted every so many years. So we have to look at all those data very carefully. But it seems that the transmission is likely to be less rapid than it had been in the past, because there are many more fixed rate mortgages now in the euro area than there was, say, 15 years ago. And that's not it. We need to see it then, channel to the third step, which is inflation. So we want to see that transmission strength through step 1, step 2, step 3, and make sure that this is really having an impact in terms of the fight we have against inflation.
Governor Ueda, do you worry about the impacts, the lagged impacts of their policies on the global economy and on your economy?
Oh, yes, but for ourselves, we haven't had any serious monetary tightening for 3 decades. I was a board member of the BOJ 25 years ago. Then the policy rate was about 20, 30 basis points. Wow. Now, minus 10 basis points. So,
and it doesn't sound like it's changing anytime soon.
So in terms of that, the lag in the effects of monetary policy could be at least 25 years. We'll see what will happen if we get to normalize policy seriously. But we'll have to be very careful here.
Be careful what you wish for, I guess. So, Chair Powell, are you more worried about the lag impacts than they are because they're still hiking rates?
I don't know. I wouldn't want to compare. I would just say again, so what's different this time is actually, though, that markets move substantially in anticipation of moves. So by the time we lifted off in March of 2022, the 2-year had moved from 20 basis points up to 200 basis points. So financial conditions now move in expectation, and the whole modern communication strategy really helps that along. So that is different. What may or may not be different, and we also haven't had this kind of tightening in 3 decades. Really, we've had tightening, but it wasn't. This looks more like tightening cycles from the 70s and 80s. So what we see is a picture of literature that has the older literature says a year or two for activity and add a year for inflation. There's new literature that says it's much faster than that, and I think we just have to use our to watch and see what's happening. There are beginning to be there are reasons to argue that it would be faster this time or slower this time, but I just don't think we know at this stage.
Well, it kind of gets into the question about the markets, and you're saying that it's a transmission mechanism. You're all talking very hawkishly and saying there's more work to be done and we're still worried about inflation. The markets pretty much think you're almost done, all of you guys. Maybe one more hike in July and then done, and then into cuts next year. Is that wrong, President Lagarde?
Man, useless.
The data we have,
Absolutely useless.
I look at the mandate we have, I look at the transmission lag, and we've decided for ourselves that we would use 3 criteria. That's what we are focused on. Of course, we are not completely oblivious to what happens in markets, but we have to be guided by what the mandate is, what the data delivers, and what criteria we take into account in order to determine our policy and to establish our stance going forward. That's the only way to go.
But I guess, there's financial conditions, and I don't know, Governor Baylor, are they working against you? You're trying to fight inflation, and MSCI World is up nicely this year.
Well, by the way, I mean, the market, I don't think thinks we're nearly done at the moment. I mean, they've got a number of further increases priced in for us. My response to that will be, well, we'll see, because we are, as we were saying earlier, we're essentially evidence-driven in that sense. So, we'll make our decisions based on that.
Useless.
I think you're right to point out, as you said earlier, and I would draw this point out, that there are 2 parts to this. There's where the peak is, and then how long it's sustained beyond that. And I think both of those are relevant. Both of those are things that will, sorry to state the blunt and the obvious, will emerge with time. But I've always been interested that the market thinks that the peak will be quite short-lived in a world where we're dealing with more persistent inflation.
Right. I mean, they did finally price out the cuts in the US a few weeks ago. Market was primed for cuts. I assume you were pleased to see that that's no longer the case.
So if you go back and look at forecasts from the participants on my committee on inflation, you'll see, we've been consistently thinking this is going to take some time. It's going to be a process that will take longer than we would have hoped. And it may well be a bumpy process. But markets have gone back and forth between pricing and what appearing to price in pretty quick declines in inflation to coming back to being more in alignment with the thinking of the committee. And that's where we are right now, is closer to where committee participants are. But as Christine said, we're not focused on what the market's forecast is. We have our forecast, all of us who are on the committee. We work hard to develop an understanding of what's driving inflation and what the path forward for inflation is. We make our best estimates. And that still is that it's going to take some time. It's just going to take some time. Inflation has proven to be more persistent than we expected, not less. And of course, if that day comes when that turns around, that'll be great. But we don't expect that. We don't plan for it.
So is it counterproductive to you that the stock market has rallied, the bond market has rallied? I mean, the market is fighting the Fed. The market thinks you're closer to the end. And I mean, that does make financial conditions easier.
I like the host.
You can't fight the Fed, but they're fighting the Fed.
Host is good.
Is that a problem?
I don't see it that way. I don't look at it that way at all. Honestly, we have different jobs. Our job is to bring inflation down to 2% and sustain maximum employment. That's our job. That's what we think about. We look at the data, and that's what we care about. And markets react. Different parts of the market react in different ways. It's just not something that is a principal focus of our work.
But it did seem last year like you wanted a weaker stock market. You used the word pain at Jackson Hole. It seemed like you were trying to communicate that financial conditions should tighten, and less so this year. Is that right?
Not really, no.
Okay.
Of course, we work through financial conditions. That's what we do. Our rate and our, all the things we do and say work through financial conditions to affect the real economy. That's how it works. But it's broader financial conditions. So we're not focused on any one market. We're never thinking, oh, let's do this to this market. It's just in general, let's communicate what we want to do and why we want to do it, and financial conditions adjust. And that's really all we can do. We do not target particular parts of the market, although of course we do monitor market conditions.
So you don't care what the stock market's doing?
I look at broader financial conditions. It's one of many conditions, along with interest rates, credit spreads, everything, all of the conditions and the availability of credit. It's one of many things. And again, we don't focus on any one thing as the key thing.
Governor Wada, how important is it to you, the markets, as it relates to financial conditions and
at least
the
he said
mechanism
he
for
anticipates a strong
monetary
likelihood of
policy?
recession. At least we got
I mean,
that.
the stock market.
Powell.
Stocks,
My
bonds,
gosh,
currency.
man. Hard to
So
stomach
stock
this.
prices have been rising fairly sharply since spring this year. Stock prices theoretically are affected by interest rates and investors' view of the economy. We haven't changed interest rate, so probably investors have become more optimistic about
My
the
gosh,
economy.
I can't listen to this guy anymore.
Of course, we don't want serious financial imbalances in the economy, so we keep monitoring.
How do you think about, President Lagarde, the risks to the economy, especially geopolitical risks? In Europe now we have this, we were all glued last weekend to the news out of Russia and the Wagner rebellion, and we're wondering if now political instability in Russia presents a further geopolitical risk to the global economy.
And I think I look at it, we all look at it, and we are all concerned about geopolitical development by virtue of the profession that we have, because it does have an impact on supply chain, it does have an impact on trade, it does have an impact on the uncertainty. And we can only say that at this point in time, uncertainty is high overall, and a big factor of that uncertainty has to do with the geopolitical difficulties and conflict or quasi-conflicts that abound at the moment. So yes, we are looking at that, but do we have to make a moral judgment on this, that, or the other? This is not the job that we have, but it clearly has an impact on how the economy is going to change and be transformed, and whether it will have an impact that is inflationary or disinflationary, I think is also to be determined. I think there will be various schools of thought along those lines.
Yeah, I wonder how you think about next winter. I mean, Europe got lucky.
We hope it's mild.
What if it's not?
But storage is what, 69%? Michael, the expert on Isabel's panel, said that 69%, and we are going to hit 95% by the end of the summer. So that should put us in a good position for the winter. But I'll say one thing, which probably we had not factored in sufficiently, and maybe that applies to all of us. It's the resilience of our economies and the resilience of the entrepreneur, the corporates, the way in which we have sort of, in a matter of a few months, reorganized ourselves. Just think 1 year back, everybody thought that the German model was dead, that Europe was going to be completely on its knees. Well, these things have not happened, and the resilience has been demonstrated at all levels of society.
Well, they printed money, hundreds of billions of dollars. So
that resilience, I mean, you see it when you talk to businesses. I spend a lot of time talking to businesses, and I've spent a lot of time in recent months talking to food-producing businesses to try to understand the sort of, the slower than, frankly, we expected decline in the rate of food inflation. And one of the things that I get quite consistently, and this is where sort of the Ukraine-Russia situation comes through for real, is they say, well, last year we bought forward sort of supplies to a much greater extent than we would normally do because we were not confident we could actually get them. Consequences, we've locked in higher prices for, sometimes they say 6 months to me. And that, of course, is affecting the passage of inflation, particularly for food prices in this case. So these things do have a very direct effect and are continuing to have a very direct effect, actually.
But there's nothing central bankers can do about that, is there?
Well, I think the first thing we need to do is understand it. That's a good starting point. Well, we have to then design.
You can always just keep crushing demand, but you can't do anything
well,
about
we have
food
to
supply.
design policy. I mean, we have to design policy and take our decisions with the best we always take policy decisions on a forward-looking basis. So we have to do it with the best information and understanding we can get of these things.
So to what extent, I guess, is the war in Ukraine driving supply side inflation for materials around the world?
Well, following on from what I was just saying, I think the conclusion I draw from that is, and this is what the businesses tell me, is yes, we are going to see actually a fall in the rate of food price inflation, for instance, but it is taking longer than we expected. So that's what we have to factor in and decide how best to, in a sense, to respond to that with monetary policy.
It's not just Russia. Governor Ueda also, we're following the tensions that have increased between the U.S. and China, between Europe and China. Do you think that's having a material impact on global growth?
Well, at least there's a tendency to relocate production sites out of, say, China into other Asian economies, including to some extent Japan. So in the short run, this is having a small positive effect on the Japanese economy through business fixed investment. But in the longer run, there will be inefficiencies all over the place. So we'll see.
So Japan's a beneficiary of the flight out of China?
In one sense and in the short run, but in the long run, I'm not sure.
I mean, Chair Powell, how do you think about, it's obviously a risk and it hurts trade. How do you think about the U.S.-China relationship as it impacts the economy?
We don't have any role to play in the relationships between the countries, but China's a very large, important economy. It's a big trading partner, mainly consisted of us buying things that are made in China. I don't think, and of course, and the Chinese economy came out of the COVID and looked like it was recovering strongly. Now it doesn't look like that. It looks like it's slowed down, and there's some issues there. From the U.S. standpoint, at the margin, that probably means a little bit less global demand. I wouldn't say it's a first order consideration for us, though.
How does Chair Powell reference the disappointing nature of the Chinese economic recovery? How does that play into Europe's recovery or the global growth picture?
Well, first of all, I think we have to be attentive to the emerging market economies at large. At the moment, they are producing about 60% of global growth, some of which is now a bit more focused on domestic development and consumption and less so on trade. But if you look at the trade volume numbers from China to many other countries, particularly the advanced economies, that has not changed significantly. So the trade volume is still significant. And I'm not breaking any news here. The Chinese authorities themselves say that they're likely to have a 5% growth this year in 23 rather than the 6% that they had initially forecasted. So that will have an impact, given the size of the Chinese economy, on global growth at large. We have to, when we do our projections, when we look at the economy, we look at the global economy, and then we sort of narrow down and zoom on the European economy and the euro area in particular. But everything that happens in China, in the United States, in the UK, in Japan, in emerging market economies actually matter for us because we are strongly interrelated and have been trading with each other for a long time. And if anything we've learned from COVID, in addition to the pain and suffering for many, is the fact that we are vastly dependent for the supply of rare earth and various metals that will be critical for the development of the economy of tomorrow if we decide to firmly go towards the green economy that we should be aiming for.
I like the questions. She's doing good at the questions.
Yeah, as an open economy, one of the things is just exactly as Christine says in terms of how we do our process. One of the things that we spend quite a bit of time on is world export prices. Now, actually, in the recovery from COVID, and of course, this was the supply chain shock, we saw quite a big contribution to goods price inflation from world export prices. We're now seeing those prices definitely start to weaken. So that will be another determinant going forward of policy.
As central bankers, do you plan for the worst case scenarios on the geopolitical front?
No.
I mean, if China invades Taiwan,
no,
then
they
what?
don't.
What does a central banker do?
Collect money.
Is there a contingency for that, Chair Powell?
We use our tools to achieve our legal mandate. if that happens.
Trash, Powell, trash.
Got that Fed speak down. You'll hold a special meeting. Special. No, I mean, it's a volatile world we live in, right? And then
So
there's
we do
impacts.
have, in every FOMC cycle, we look at, our staff works up 6 or 7 or 8 alternative simulations, and they simulate, different things. It's not so much geopolitical events, though. It's more different ways the economy could play out. And we all the participants read those and think about them and talk about them, and they come up in our meetings, we talk about them. So it's very helpful, because you can't get too focused on the modal path in a world where it's just very hard to predict the economy. Even in normal times, it's very hard to predict the economy, let alone times like today.
What sort of simulations
thanks, Jerome
do
Powell.
you talk about?
A lot of faith in you now.
I'm going to leave that to your imagination.
I'm going to leave it to our imagination.
I bet I can think of a few. President Lagarde, Chair Powell did talk about, one of the things that I don't know that there was a simulation of is we had a few bank failures in the US this year. And I know it forced some of you into action to shore up banking systems. Are we in good shape now? Is the global and European financial system in good shape? Have we healed?
We're almost
I
done.
can only speak to
Sorry,
the
I know,
the
man.
banks over which
Oh,
we have
this lady's
supervision.
talking.
And
All right, you guys,
those
I'm
are
gonna
the euro area.
I'm done with this. I'm sorry, guys. I am done with this. I can't do it anymore. But I put a link in the description if you want. They're not answering any questions. I think that she's got some really good questions that she's laid out, and just depressing because we're not getting any truth. We're not getting answers to the difficult questions. Jerome Powell sounds just like Ben Bernanke, that was basically saying everything was okay until the whole market crashed. Literally, when the whole market was crashing, Ben Bernanke, the federal chairman of the Great Financial Collapse, pretty much was completely useless to consumers, right? For consumers to prepare. And these officials, what do we get? What do we get from listening to that? What I got from listening to that is we're not going to be told the truth. And what I also got is they don't know what's going to happen. And they also anticipate a recession. It's just, it's very hard. But I do agree, it's very hard to understand what's going to happen next, which is one of the points that I try to make when it comes to buying a house. When there's so much uncertainty, it's generally not a good time to purchase, right? Unless, like Jeff M found a great deal in a difficult market. That should be something you guys stay on top of, obviously being educated in your local housing market, things of that nature. But how disappointing is all of this stuff to you guys? This is very, very disappointing. Let's see how the market is reacting real quick, guys, and then I will let you go. I'm going to switch to this right here and then do this. Okay, let's just take a quick look at the market, see if anything's changed from that absolute garbage, useless speech and talk that we listened to, where they're not answering the questions like we need, but that's okay. 10-year it's down 1 basis point, pretty much unchanged. Let's see if the mortgage interest rate's updated. Yeah, I'm thinking it's going to be higher. Let's see. It's unchanged still. That's all right. Now, real quick, guys, I'm not going to cover this like I wanted to, but I just wanted to point out real quick, Case-Shiller did update. Let me do the 5-year. So the Case-Shiller, basically, here's the thing with Case-Shiller. Now, we want to look at year to date, but we don't only want to look at year to date, you guys. Year to date is super lagging, but year to date, the Case-Shiller is down year over year. The most it's been down since 2012. So if the Federal Reserve stops propping up the housing market, the bailout stops, all of the things stops, then how can this possibly keep up? All right. But again, I just wanted to point out, but year over year is over here. Okay. So year over year is where I have the arrow right now. So basically April of 2022, the rating was at 301.77. So it's comparing right here, you guys, to where we're at currently. And that for the first time since 2012 is down year over year. So there's our year over year decline with the Case-Shiller. I like the Case-Shiller, you guys. Let me tell you guys, one of the issues with Case-Shiller is, in my opinion, it's really better. And also there's other value equating algorithms that are used. But Case-Shiller, I do like. The problem with Case-Shiller is it lags. And that's why I really stay on median sales price. Median sales price is generally not a good way to look at value, but it is something that we can consistently review. Now, generally value is created by sold properties, or what's called comparable sales. And it's those comparable sales that are used, or sold properties, so sold property comparable houses, that are generally used for an appraisal. So generally, an appraisal is what is used to come up with the value. An appraisal costs $500, $600, $700. That's why a lot of people don't get the appraisals, but that's why we're using, median sales price, guys. It's readily available. I would prefer to use Case-Shiller. Super duper lagging. It is what it is. Let me go and see the CME Fed Watch, and then we'll get out of here. I really appreciate you guys tremendously. All right, what's going on here? All right, let me refresh this. Let's see if we had any changes. Yep, we did have a change. Wow. Okay. So we had a pretty large change actually in the Fed Watch tool. So this is a Fed Watch tool. We started out the morning at about 74. We went all the way up to 84.3%. This is basically the market saying we anticipate a federal funds or discount rate hike July 26th. Okay, so it's pretty much guaranteed. But I'm more interested is what is the market pricing in for September? Let's look at September change. It was about, oh my God. Okay, so it doubled. It doubled. Okay, so yesterday we were sitting at a 10. So here's what I'm saying. Yesterday, before this talk, and honestly, the talk was weak. The only thing that I got from the talk is we can't rely on these people, and Jerome Powell thinks there's a high likelihood of recession, as do those other world leaders. But look, yesterday was about 10%. Now the market's saying there's a 21.9% chance, you guys can see that right here, that there's an additional rate hike in September. Kind of like Jerome Powell has been, not Jerome Powell, but kind of like the Federal Reserve has been telling us they're going to do 2 more rate hikes. So that has doubled in one day. Still way under 50%. Okay, 20% is not a lot, but that trend is increasing. Let's look at November. Now, yesterday, November had the market was saying the highest likelihood for a second rate hike was in November. That was yesterday. Let's see what it is today. Okay, yeah, unbelievable. Unbelievable. Okay, this is way up. Dang, that's crazy. Okay, so again, market is still thinking, they're saying no though overall, I'm just saying, but as far as the likelihood, right, we're talking about the likelihood, but the market is saying the likelihood is going to be, the second rate hike is coming possibly in November, 30% now, okay, 30% likelihood. That's up double as well. That's pretty shocking. Let me look at December. Really surprising as well. So December, wow. So all of this has basically doubled. That's really surprising. So market's really not pricing in any rate decreases. They're pricing in 1 rate increase July, and they're not quite pricing in a second rate increase yet, but it's kind of being forced into that. You guys can see that here. This is doubled. So very interesting. And then I just wanted to show you the inversion. Let's see if this is updated as well. Right now it's sitting at 0.97. Yesterday, before it updated, it was at 0.93. So the inversion increased. The depth of the inversion increased. This isn't updated yet. But I just wanted to, to remind everyone here that thinks that we're wrong and that the government is not really bailing out the housing market and economy, which is exactly what happened in March. So are we really wrong? We're wrong about the bailout, right? The thing is, guys, this is still, look, oh my God, this is a huge warning sign. All right. I know, I understand the bull and the bear arguments. I get all of that. I'm watching the money. Okay. I'm watching the money. I'm not fighting the Fed. I'm not saying this time is different. I'm playing history. You know what I mean? To the haters, give me a break. You know what I mean? We're playing history here. Give me a break. So we're not greedy. Okay. We're just normal consumers and we don't want to get hurt. So I just wanted to remind you guys, we have been inverted for over a year now. And the depth of the inversion is similar to the 80s and 70s. This has not improved. The inversion has not improved. The yields have been like crazy high. And really what that's saying to me, at least, is there's a lot more things to come, y'all. A lot more pain to come. And that we should be cautious. We should do our own thinking. And if we are on the sideline, we should increase our purchasing power and our understanding of the housing market. If we're not on the sideline and we're actively looking for houses right now, like Jeff was, you want to purchase smart, right? You don't want to get into bidding wars. Getting into a bidding wars is an emotionally distressful time. Do not allow yourself to get hooked in bidding wars. Follow the data, find that great deal. But the number one thing, and this is to Jeff, right? This is what Jeff held on to the entire time, even though he was venting and throwing up his concerns on our comments. He was throwing up the concerns. He never gave up hope. All right. He used to talk like he was, but we were the community he loves. We were there to hold Jeff up. And because he didn't lose hope and he stayed, really active in his market, he had a great relationship with his realtor. He found his dream home. But that's not all. That's just one of the equations. He found his dream home and he got a good deal. There's two things here we need: great home, great deal. I'm not going to say he got a great deal. He got a good deal on his primary residence on a home he loved. And for that, I say congratulations. And another one, I'm not sure if Lex is watching, but also another member of our community, Lex, same thing. So in other words, you guys, things are changing. To me, the prices are still nowhere near where they need to be. It's still very difficult to find a great deal, but that doesn't mean we should stop trying. If we stop trying, if we stop hope, if we give up, then we're going to be, some of us, we're going to be stuck on the sideline. We're going to be stuck renting. We're going to be trapped renting, and we don't want that to happen. We need to stay prepared, you guys. We cannot get content, and it's really easy to stay prepared, right? Credit, income, assets. Become an expert in your local housing market. It's not that hard. Anyone can become a realtor. And also, you guys, here's the thing. You may want to look at getting your realtor license. And there's a lot, and I'll cover this more, but there's a lot going on right now when it comes to realtor commissions right now. So there's a lot going on there, not to mention Airbnb. Oh my gosh, you guys, Airbnb right now is getting destroyed right now. In the sense that there are more metro areas that are now banning Airbnb on top of profits down 50%. And Dallas just banned Airbnb, you guys. So good things are coming. Also, institutional investors. The top institutional investors are essentially no longer purchasing real estate, which thank God, and they're now selling. Now, the thing is they're not selling enough for it to like really rebalance the housing market, but at least it's a start. There's a lot of things that are starting. One thing that I'm worried about is the commercial real estate meltdown. Commercial real estate meltdown is right around the corner, but the worry that I have about that is the QE. Because we saw that in March. We don't want any more QE because obviously when they pump in more money, even if it's to the financing sector, it's going to spread to other sectors, right? When it's not just going to be confined to the financing sector, that money is going to spread. And actually it's going to spread, in my opinion, even faster in the financing sector, because what is the job of banks? To lend money, right? That's their job. So obviously, if you're giving $400 billion to the banks, their job is to get us that money. Inflation's going to go up. So really the question is like, who's going to get elected next? You know what I mean, guys? Like, who's going to get elected next? I don't know. I don't even want to get into politics, but I'll tell you one thing. Things are absolutely wild right now. Everyone should be doing their own thinking. On my channel, we're going to remain cautious and we're going to remain hopeful. And other than that, guys, I really hope you guys have a great day. We're going to end it. I'm sorry that the Jerome video didn't turn out a little bit better, but I definitely appreciate y'all. And if you're out there investing in real estate, you already know I wish you luck, and I hope you win. You guys, make it